Okay, in this video, we are going to use these transactions and the accounting equation to prepare the financial statements. This is the accounting equation: assets equal liability plus owner's equity, and A through H are your transactions, and every time you see the word BAL period, that is the balance of each account. So for example, cash has an ending balance of $900, office supplies has an ending balance of $550, and so forth. Now, an accountant could look at these transactions in this worksheet and understand what is going on with each account, but you have to remember there are other users of financial information besides accountants. So in order to report the transactions to, let's say, creditors or investors, we have to put it in a format that is easy to understand and see the overall picture. So the way we do that is we prepare the financial statements. So we're going to prepare financial statements, and the first financial statement that we're going to prepare is the income statement. And the income statement shows that revenues minus expenses equals your net income. If expenses are greater than your revenue, then you would have actually a net loss. The next statement you would prepare is the statement of owner's equity. And this statement has all the components listed in owner's equity. Up here, all of those are included in this balance. So to calculate owner's equity, you begin with beginning owner's equity, and then you add your net income, which is the sum of revenue minus expenses, and then less your withdrawals, and that will give you ending owner's equity. Next, you're going to do the balance sheet, and this is basically the accounting equation, which is at the top of the sheet, and it is your assets equal liabilities plus your owner's equity. So those are the three statements that we're going to prepare in this video. Okay, so we're going to prepare the income statement and start with fees earned, which is the only revenue account that we have. And since there's only one revenue, we can put it on the outermost column. And then we will list our expenses. Now for your expenses, you have several different expenses, and it's important to break those down so that users can see the different types of expenses that we have. So for wages expense, we have $2,125, and then for rent we have $800, and we know these are expenses and we're going to add those up. Supplies expense is $800, and utilities expense is $450. Miscellaneous expense, let's see, miscellaneous expense is $275, and we will sum all of those up, and this has already summed it for you. And so we take our fees earned less our expenses, and that gives us our net income of $3,050. We're going to prepare the statement of owner's equity. Chris Clark Capital, there is no beginning capital because this is a new company. So he started out with 0 in owner's capital. So 0, and then any investments would be always found in the capital account. So as you can see, the capital, the first investment was $25,000. So that will be added with net income, and you find net income from the income statement. We've already calculated that to be $3,050. Okay, and then your withdrawals is going to be, let's see, it's $2,000, and I'm trying to make this screen a little bit bigger so I can see it better. But the total increase is going to be your investments plus your net income minus your withdrawals, and that would be $26,050. You may have to fix that in your formula sheet. And then your ending capital is going to be your beginning capital plus your change, since it was an increase. So that would equal your beginning plus your change, which is an increase. Now, if it was a decrease, then you would have to subtract. Like if the change was, capital went down, you would have to subtract for that. Another thing to think about is this number, the increase in the ending capital would not be the same if beginning capital was zero. If beginning capital was not zero. So these two numbers usually are going to be different. Also, net income always increases owner's capital, but if it were a net loss, then it would be a decrease. Notice that our ending capital is $26,050. Also, if you were to go up here and take all of these numbers and sum them, you will get $26,050, because owner's equity represents all of these numbers, which are included on the income statement and the statement of owner's equity. Now, the last financial statement that we're going to prepare is the balance sheet, and I've actually put all the accounts up here already. So you have assets equal liability. It's just your accounting equation plus owner's equity. So the balance sheet should balance. So we have all of our assets listed, and cash is $900, office supplies are $550, so we'll put those in, $900, $550, and then I believe land is $25,000. If it doesn't balance, then we'll know. So we're going to sum our assets up. And then our accounts payable, I believe we owed some, let's see, $400. And then your owner's equity, the number that goes here is actually the ending owner's equity, or the ending capital. So that's why you have to prepare it in this order. Each financial statement requires a number from the financial statement above it. So the order is super important. Now, if this sums up, then our balance sheet is balanced, $26,450, and that is how you prepare the financial statements. I will do a video on the cash flow statement separately. It is also another financial statement that you will learn to prepare.